All right, so now we're on to our final piece here before lunch, also our final piece on capital markets. With me is Billy Rahm, Managing Director, Head of Real Estate at Centerbridge. Welcome, Billy.
Thank you.
That would be a good place to start at your origin story, maybe how you came from Yale and your career in real estate and ending up at Centerbridge and your role there now.
Sure, well, I'll keep it fairly brief. I was a history major at Yale, didn't know very much about business or real estate. Someone who was captain of my team at Yale had gone to Goldman Sachs, encouraged me to go work in merchant banking there for a summer. I went there and I heard about this relatively small firm, Blackstone, which had a little office in New York. I went there after college for a few years. We opened London. Firm grew a lot while I was there, obviously a lot more after I left. The global head of private equity there, Mark Alogli, left in 2005. I went back to grad school during this period, and then Mark asked me to come join him and Jeff in a nameless, teamless, fundless venture that became Centerbridge, and I have been part of that team for the last 17 years. And the origin of the firm was really the idea of bringing together actually private equity and credit. The co-founder, Jeff Aronson, my partner, ran credit for Angelo Gordon. And real estate became kind of the third leg of the stool. I would say it was something that both Mark and Jeff were comfortable with because of the history of Blackstone and Angelo in real estate. And then, to be honest, during the financial crisis, it was a tremendous investing opportunity. We had some combination of smarts and just a lot of good luck that we didn't do very much between 2006 and 2008. So we had a lot of fresh capital and ability to play offense with no real legacy investments. And we were very active during the financial crisis and really grew a real estate business, I'd say, in the image of the firm, which was to think deeply about the value of businesses or properties or other types of assets, how we could increase that value, and then how we matched the capital structure against those, and to the extent that we were going to the secondary market, how that capital structure created risks or opportunities for us to invest in. So really the sense of both sides of the balance sheet, the asset side and the liability side, were at the core of the firm and working as one team to try to identify opportunities is something that we've done for a long time.
And how about today in today's market, where's Centerbridge focused in terms of real estate investing?
Yeah, I think a little bit, if you think about the origin of our firm, when you wear two hats, and particularly in real estate where you've seen a lot of people struggle with leverage, it tends to shape your perspective on how you build your own portfolio. And so we, for many years, had focused on how do we generate equity returns without having to rely much on leverage. That had really moved us into some asset classes that we thought were not well understood for their secular growth and for, frankly, the unlevered cash flow earnings power that they achieved. It's one of the reasons why we haven't owned an office building in 15 years. It was really not because we foresaw, frankly, anything that came with COVID, just because when you're focused on unlevered yields, that was just never an asset class where you could compete. And so we started to build businesses in the manufactured housing community space, in self-storage. We own the largest standalone marinas platform. And where we have done things in multifamily or industrial, until more recently, it's been much more special situations because the cost of capital was so low that people pursuing those areas were really paying quite high prices. And if we weren't going to rely on leverage, it was hard for us to make our returns. We have, since the financial crisis, had moments where we've played actively in credit in the secondary markets. That was mostly during sort of the spring of 2020. But to be honest, for most of the last 10 years, it's been better to be a borrower than a lender. And so we have not been particularly active in credit since the financial crisis, but for that period of real dislocation from kind of March through, I guess, when the vaccines were announced in November of 2020. We have started to do more direct lending through some insurance capital that we have, and because frankly, it is a better time to be a lender than a borrower. And where we are investing in equity, it's really in assets that we think we can generate strong unlevered yields and not rely on leverage either during our hold period or, frankly, for the next buyer on their cap rate. Because it's so hard, as many people have said, to predict cap rates. But if we can, really identify assets or platforms that can create unlevered yields in the 9, 10, 11% range, we can absorb a lot of cap rate expansion and still make attractive returns. And that's really where we've tried to focus. And I think that the world is sort of coming to us. There's going to be a lot of opportunity over the next several years in more traditional asset classes. I think we've spoken a little bit today about multifamily and industrial. I think that those asset classes are going to face a lot more pain than maybe is fully appreciated. Not because the fundamentals haven't been good, not because people haven't achieved business plans, but just because price still matters. And, the cheap cost of capital allowed people to invest at exceptionally high prices. And they have not faced the fundamental headwinds that office has, which I know we've talked a lot about today. But there's still going to be a lot of repricing and I think restructuring of even traditional strong asset classes just because of price and because of the basis at which people were borrowing capital.
So would you say today that you're being more of a patient investor, or are there certain asset classes that you are more active in where you are getting those unlevered yields?
Certainly, if you want to try to achieve strong unlevered yields, but you still want to be in asset classes that have good supply and demand fundamentals, the aperture is quite small. And so we do have a few things I mentioned, in marinas, where we have the largest platform in the U.S. and where net new supply has been zero since 1975, but there have been more and bigger boats over the last 45 years. We still can buy things in the sevens and with operational improvements because of our scale, get them to nines and tens. We see a little bit, but less of that in some other specialized storage areas. We see some situations in industrial where we can get not quite to those levels, but get into the sevens, and maybe because of the rent growth, if we get things, I think particularly at portfolios where there's just a much less competitive audience today, maybe get into the eights. But I think there's going to be more to do in providing capital in multifamily than there has been in the past. And we're doing a lot in what I would call sort of performing credit, where we're simply able to take senior parts of the capital structure and generate quite attractive returns with good assets and good markets and good borrowers. And that's over the last 20 years, that really hasn't been available because when spreads have widened out, base rates have tended to fall with the Fed's actions. And I think you're going to have a pretty long runway where, and we've talked a lot about the Fed cutting rates here. We haven't talked that much about the 10-year, which the Fed can only really control through quantitative easing or tightening. And I think that if you simply look at the Fed balance sheet and how little they've done to unwind that, there's a pretty long runway where I expect rates to stay elevated on the 10-year. And I think that combined with spreads, which will likely stay high given all of the pressure on banks for lending, will give a really great opportunity for new credit origination, for the next several years. And I don't know how long that lasts, but we've been a believer since certainly the summer of 22 that it was going to last a lot longer than many of our peers were underwriting. So I think that's continuing to be a real opportunity.
And how about the hospitality sector? That was mentioned a lot earlier as one of the areas, asset classes, where deals are getting done. Is that somewhere you are involved?
We have been very involved over time. We've owned hotel businesses and hotel assets. We've even known them in some niche sectors. Like we sort of really helped grow an indoor water park resort business, which I probably know far more about than I expected to 10 years ago. I think that there is opportunity certainly in hospitality. We're always reminded that we don't know exactly what's going to come over the next 12 months economically. And while there's some evidence that we will have still continued growth, there's risk around recession, and it's probably the most volatile asset class from a top-line perspective. And I think that the operating leverage that's baked into hospitality means today that you're unlikely to see a huge amount of cost compression if you see top line go away. I just think that the embedded wage rate growth and some of the other fixed costs make that difficult. And so we think it's probably better to be a lender in that space today. I think there's selective things on the equity that we would do. But given the uncertainty and frankly, given the peak earnings that a number of high quality hospitality have enjoyed with the recovery after COVID and frankly, the tremendous leisure demand that's been created, we're probably more cautious on buying based on that peak earnings at a multiple that someone would want to sell at. So I think there's possible that we do hospitality equity. I think that that's less in the pipeline right now, but something that certainly could emerge. And if we do go through a recession with high rates, that's always an area where I think people tend to be quick to sell, and an opportunity that we would jump on.
And of course, I have to ask because everyone has an opinion on it. Office is dire in everyone's view. Do you share that view? Do you have any contrarian view? What happens to non-Class A office?
I don't have a great answer for non-Class A office. You can't have avoided something for 10 years and then claim to be an expert on it today. So I'm really not an expert on office. I think that the reason that we weren't in it was that we've historically felt people underestimated the capital intensity and cyclicality of office. I think people appreciate more today that, and as a team that focuses a lot on unlevered cash flow growth and how confident we can be because of supply and demand that we can predict the unlevered cash flow growth. Office was never really a great asset class to focus in, and when you then added the factor that it had huge institutional capital flows, so it traded like a capital light, stable asset, even though we viewed it as a capital intensive cyclical asset, it just meant it was something that we avoided. I mean, the evidence suggests that certainly for well-leased, high-quality office assets, there's going to continue to be demand. Nobody's building them. And I think the easiest way, frankly, for us to express a view there might be through credit or some kind of structured investment. I don't think that today we see enough opportunity for us to step into the equity of most office, and we really don't have a lot of in-house development capabilities. And so the idea of buying something to redevelop, I think, is challenging and often doesn't work within our time frame if you have to go through some kind of rezoning development process. In the markets that we would want to be in, they tend to be very difficult markets to build.
Flipping to the view of your investor base and your funds, how has their temperature changed? We constantly get the question, what's your view on the next 6 to 12 months, which is really just them trying to feel good about what we're doing. How have you all been handling that, and what is the house view in the short term?
The house view on our own fundraising, meaning, or on the markets generally?
Markets generally. And fundraising, since you...
Yeah, I think in the markets generally, I think there's going to be a tremendous opportunity in 24 and 25 in real estate. I think that the last 6 weeks of, frankly, the pressure on the treasuries and rates rising, at the time of year when people tend to make their business plans for the following year, mean that there are a lot more people who are thinking about selling things at different prices or trying to bring in a different kind of capital to extend runway, but are less confident that they can simply hold on for rates to fall, cap rates to compress again, and then just simply sell in late 24 and 25. I think people realize at a minimum they have to start chipping away at their issues, and maybe they have to address them head on. So I think that's going to create a lot of opportunity for us. In our funds, we tend to have, frankly, a lot of uninvested capital, and we fortunately don't have a huge amount of issues because we never used a lot of leverage. I think our first fund is 40% levered, and our second fund is in the low 40s. I think from a fundraising standpoint, the last few months started to see LPs become more active and start to make their own plans for 24 allocations that were going to grow again because they felt like they were through the denominator effect that I think they started to feel acutely at the end of 22. I'm not sure that that is going to persist as well if equity markets fall. And I do think that, one of the benefits that a lot of investors felt about their private market books was that there hadn't been a lot of markdowns. And I think they knew that there was more to come, but I think they're going to start to see more of that, coming. So I think it's really, the denominator effect is very real in how our largest LPs think about allocations. They may have capital, but their amount of capital available is very much driven by what the denominator is. And so if equity markets are very high, or if their fixed income portfolios rally, then I think they will have more allocations for real estate. I think there are a few of our large investors who have contributions into their pools of capital, so it's not purely based on the investment portfolio, but that's not the majority of our clients. And I think that the majority of our clients are probably shrinking the number of accounts, trying to think about which of their partners have the flexibility to operate in this environment. And they're trying to look for people who can take a view on a certain real estate asset class, but express it in multiple ways throughout the capital structure. So I think that generally plays out relatively well for our business and our approach. But you can't get away from a shrinking market. And so I think that, that will be a headwind for fundraising in 24 and into 25 if you see equity markets fall and if, the fixed income markets continue to be under pressure because of rising rates.
And it seems like you've done some niche market investing, marinas. Are there new niches you guys are focused on that you may see opportunity coming up, or just other contrarian views that you all have from an investment standpoint to the conventional market?
We have done some, but what I would say is, as a team, our consistent focus is how do we compound capital over long periods of time. And you just couldn't really do that unless you relied on leverage in traditional real estate asset classes for a number of years. And so we tried to figure out, well, what are other asset classes that can perform well and give you equity returns without having to rely a lot on leverage? But we didn't do it because we wanted to pursue complexity or niche. And I think we're going to have much more opportunity to go into multifamily or industrial and generate better returns over the next several years than we have over the last several. We did start something in industrial outdoor storage. There is continuing to be a fair amount of supply demand favoring the landlords in industrial. Industrial outdoor storage in a simple way is basically, securing a piece of income producing dirt next to industrial. We have a lot of income producing dirt strategies. If you look at MH or RV storage or certainly industrial outdoor storage. We are partnered with someone who has a great industrial business nationally. They have about 13 or 14 offices locally across the US. They really understand what the tenants' needs are. And a lot of what we do throughout real estate is to try to understand what the user business case is for the type of real estate that we're in. And do we think that user business case is growing? And do we think that we represent a small enough amount of their cost basis that we can have real pricing power? I think in this case, that is an opportunity. And so we're trying to do that. But I would say that that's, very much focused on port adjacent markets. I don't know if it'll ever get to huge scale. And I think there's just going to be a lot of opportunity in very large addressable markets that we've been sort of priced out of for the last few years.
Great. It's a great segue to my next question, which was which markets are you all focused on, or markets that are a no-go, or any trends and regions in the U.S. that are particularly attractive to you all from an investment standpoint?
Well, in addition to my comment on credit, which I would say is probably broader in asset classes, and certainly incredibly compelling, and I think particularly senior performing credit will be a great place to invest for a number of years. I would say that some of the more particularly residential focused and industrial and some of our nichier asset classes, but I love the marinas business for the reasons I described, but our business is never going to be a $20 billion business because there just aren't enough quality marinas to buy. I do think that you can scale things in a couple of different residential areas and industrial to a much greater degree than we can in some of the niche real estate asset classes. And I think that's true in Europe, although Europe is a complicated set of markets that we talk about as one market. We recently announced the sale of our self-storage business to Scandinavia. We have done over time certain residential strategies actually in Poland. We used to own a home builder with Goldman Sachs, which we sold in 2021. Interestingly, we sold it to a German public residential company at a time when they had unbelievably cheap cost of capital. I loved the chart which showed German rates started at negative levels and topped off at 3.5%. I just thought that was telling that that's what your y-axis was in the chart. So, German residential companies are under tremendous pressure, and I think that they're going to be pulling out of the market, and there may be places where much higher cost of capital can earn good returns in what is still a housing-short country. So we're trying to take some of our themes globally. I think that we're always focused on what the capital intensity is. In a higher cost of capital environment, I think you need to be. And so, that's one of the reasons why we were cautious in some of the life sciences areas, because there's such capital intensity to building and frankly leasing, that space. There might be an opportunity for us to step in, there as some people go through a real sort of restructuring of their balance sheets. But I think, there'll be plenty for us to do in sort of residential and industrial and some of these niche areas where, frankly, we have scalable and competitively advantaged platforms that allow us to, pay prices that are good for sellers and then earn more from those assets than they were able to do on their own. And that's, been a pretty good business model for us.
Okay, I'm going to switch to questions in a moment. I'll just ask my universal question in this uncertain times. What keeps you up at night in your portfolio or your strategies?
I think what keeps me up at night is what really happens to cash flows. Everyone wants to see rates get lower, but the only obvious reason that rates would get lower in the next 12 months would be a much more dire recession than people are predicting. And how do we actually perform in that environment? I think we perform actually quite well in a higher rate environment. We'd looked for a long time, I think from for 07 to 22, rates were so low. But if you really looked over the 45 years before that, they never really went below 4%. So we had sort of planned for businesses that could perform in a higher rate environment. And I think we're going to do quite well in that environment. Obviously, if the 10 year's at 8%, we're not going to do well either, but we might be the last to go, but we'll go too. But I do think even if the 10 year's in the 5 to 6% range, like we'll be able to make money for our clients, and we'll make less money for our clients than when we could sell things at a sub 4 cap rate. But if you can make money for your clients across a spectrum of outcomes, I think you can continue to be a good partner for them. I think if there is a severe recession, I'm trying to think through how much embedded operating leverage there is in our businesses and what would happen to cash flows. And I do think, for example, you mentioned hospitality earlier. People tend to think about dire scenarios and look back at the GFC, for lots of good social reasons, including in state laws, you have higher minimum wage rates, and that has created a higher fixed cost in a lot of hotels. And you could have much less RevPAR declines or much less severe decline in the top line and see pretty severe declines in cash flows. I'm trying to think through where else that could take place. Certainly, as mentioned earlier about Florida, nobody really underwrote the level of insurance increases that people have. we don't tend to have particularly low yielding assets in Florida, and we don't have so much exposure to Florida. And where we do, because we purchase across our entire portfolio nationally, we're able to offset that some. But that's a good example where that's just an expense growth that means if top line moderates somewhat because of new supply, let's say in multifamily, you're really not going to be able to outrun that expense growth, and it's going to have a much more severe impact on cash flow. So I'm trying to think about where we have vulnerability in cash flow.
Makes sense. All right, we have some time for questions as well. Can't really see. Kevin, you always have a good question.
I do have a question.
Wait for the microphone.
I do have a question. I'd like to know who your competitors are, and are any of them doing what you're doing?
We have lots of competitors. I think that depending on the part of our strategy, we have different competitors. So certainly, one of the reasons we didn't do a lot of lending, for example, for many years, is we viewed lending as a scale business where we are comparatively disadvantaged. And sort of alluded to, there are going to be plenty of examples where we have a right to compete and win and we'll still lose. So we certainly don't want to play in things that we don't have a right to compete and win in. So we just didn't for a long time in lending. I think the tables have turned there a bit with the banks pulling out. There is private capital, but it does not fill the gap of the U.S. banking system. And so I think that's created a real opportunity so we can step in there. Of course, we have competitors, but I think we have opportunity there. On the equity side, it really depends. When you have the secondary markets, if we're buying securities, certainly there are hedge funds that we compete with. They tend to be really shrewd, as I hope that our credit and restructuring and trading desks are, but maybe have fewer real estate insights than we have. And that's where we tend to try to differentiate ourselves. Certainly on the real estate equity side, buying real estate businesses, there are some excellent competitors. My former firm and a lot of other businesses like TPG and other people have bought and built very good real estate businesses. I don't worry too much about that. For example, once we had identified, I don't want to spend too much time on marinas, but there's really only one major competitor that matters in marinas. It's owned by a public company, Sun Communities. Sun stock's down about 50%, so they're less aggressive in buying things. And we borrow in that business. We have a syndicated loan facility from 16 banks. We swapped half of it. We're basically a public company balance sheet. It's about 35% levered. And Sun, which is an unsecured investment grade borrower, has cheap cost of capital. But the next biggest competitor in marinas is 10% of our size, and they borrow at 10+% today. So they're not really particularly competitive if there's a high quality asset. So we try to, if we're looking at a multifamily or industrial asset, there are lots of competitors. There are fewer today when you're doing a portfolio than there were 2 years ago. But if it's a $25 or $50 million asset, there are many still. And in other asset classes, I'm still very involved with one of the largest grocery-anchored shopping center businesses, which I think is actually a business that will perform quite well for reasons I could describe. At the small end of the spectrum, there still are private owner operators. There are people who have 1031 money. There's a fairly high degree of competitive intensity. Price is adjusted for everything, but there's competitive intensity. When you get to larger scale, there's much less competitive intensity today.
What's your view on data centers? Is that real estate for you? Is it infrastructure? It's capital intensive, so is that a no-go then because of that?
We've spent a lot of time in data centers for the last 8 years. One of the places I think as a firm we've done well is the intersection of where there's a specific user that comes from a sector where we have private equity insights. So our technology team helped us when we became the largest shareholder of a company we just sold to PSP and EQT Core Infrastructure called Radius Global Infrastructure. Radius owns some data centers, but was predominantly the largest owner of ground leases underneath cell towers. And understanding what was going to happen with network consolidation from telecom providers and what was essential communications infrastructure were insights which our tech and telecom colleagues really assisted us with and allowed us to make that investment. So we've tried to do that in data centers too. There are no small mistakes in data centers. I try to remind people of this. Everyone wants to serve the hyperscalers because at the end user stage, they're taking a lot of share from other businesses. And so Microsoft and AWS are going to win in the competition that they're undertaking. And when they want to be tenants, they don't want to be tenants in small data centers. They only want to be tenants in large data centers. So you have to be willing to make large development bets. I think the last 6 months, I'm not sure the exact mark of this, but whenever OpenAI sort of issued the latest ChatGPT, which took the world by storm as far as AI, people became very excited about that. I think for a lot of good reasons, and I think the leasing demand people have seen in the numbers reported in the last quarter were exceptional. But over the last 5 or 7 years, there was real rental yield compression in data centers. The balance of power shifted to landlords from tenants for the last 6 or 12 months. It's unclear to us whether or not Microsoft and Amazon just leased for 3 years and they don't themselves know whether or not in 3 years they'll be leasing for the next 3 years, or if that 3 years turns out to be enough capacity for 5 years. And if you don't know that, it's very hard to build $500 million data center today because you have no market power relative to your customer unless they have no choice, right? The largest data center company in the world is Equinix. They're 10% the size of their largest customers. And they're 100 times the size of most people who are playing in data centers. So we continue to look at that space. We've had a lot of people, we were very close to doing, we crafted with Equinix in 2017, a joint venture to develop hyperscale data centers next to their interconnection sites in Europe, in Frankfurt, London, Amsterdam, and Paris with APG. They decided they wanted to take it to Asia as well. GIC ended up doing that transaction with them. We've thought about those transactions, but it is a bit of a bet on timing of power and land, particularly power. And the use case, it's hard when even the actual users are not totally able to predict the time frame that at which they'll need the space. You can't just believe that AI is going to have huge demand. You need to believe that it's going to have huge demand at a certain moment in time when you are leasing. And that temporal nature of it is tough. So I think we may do something there, but we're trying to tread cautiously because there are no small mistakes.
One more. Do you just wait for the mic?
You talked about acquiring assets at a certain cap rate and improving those cap rates 20%. I was hoping you might provide a little color into that magical process.
Well, I'll give you an example, which we're doing less of now, but we did for many years in self-storage. So we are the largest partner to Extra Space Storage and CubeSmart. Going back about 6 years, we partnered with a fantastic woman, Liz Schlesinger, who brought a lot of her team from a company she'd worked at. We helped provide capital not only to buy the assets, but set up her business and created a board around her business, and she's been phenomenal. The simple way that I thought about her business was that she tended to buy from non-institutional players. Our favorite thing was to buy from someone who named their company to be first in the Yellow Pages. So we bought a lot from AA storage, AAA storage, affordable storage, and then we made it Extra Space Storage, who was never first in the Yellow Pages. But they're first on Google, and Google just beats the Yellow Pages. And they had invested a huge amount in digital marketing and revenue management to lower the customer acquisition cost and, frankly, increase the lifetime value of customers because of their yield management. We also found a lot of the non-institutional players, they did not change rates dynamically. And so, we would buy things at 4%, 5%, 6% yields where we had real information that the 10 by 10 non-climate controlled second story facility available 3 miles away wasn't $8 a foot, but it was $14 a foot. And then we'd make it extra space storage, and over 2 or 3 years, it would become $14 a foot. And so our 5 or 6% yield, which was a great price for the seller, they felt very good. And they weren't able to make it $14 a foot because they weren't digitally native and they couldn't really acquire customers in the same way. And even over the last 6 years, the percentage of customers who make purchase decisions online for self-storage has increased materially, and it increased in the 5 years before that, but it's gone up even more. Allows us to actually have a much better earnings power in the asset. And so we think about the asset as both, what is the seller earning, but also what can we earn with the asset, and can the asset earn that sustainably? And so if we could take something at 5 or 6 and make it a 10, and we did that in a number of cases, then we have an asset that's earning at good rates of return. And I think that's a good example of how we were able to do that. So in some places, like marinas, we've had to build those capabilities, and scale is a huge advantage. If you own a few $100 million in marinas, you cannot invest in the same kind of talent and technology that we're able to at $3.5 billion. And that allows us to have a flywheel to sustainably generate, I think, better returns on the same assets.
Excellent. Thank you, Billy. Please join me in thanking Billy for coming.